Ever felt like you needed, I don't know, a secret decoder ring, maybe even a translator,
Yeah.
just to figure out something as basic as your own tax document?
Oh, absolutely. It can definitely feel like you're trying to navigate this incredibly complex maze, often without a map.
Well, today, consider this your decoder ring and maybe a pretty detailed map, too. We're taking a deep dive into something that impacts, well, nearly every single one of us,
Mm-hmm.
but it often feels wrapped up in this intimidating jargon,
Mm-hmm.
the individual income tax formula. We'll
Mm.
figure out who actually needs to file, and maybe most importantly, what your tax identity, your filing status, really means for your bottom line.
Right.
It's not just about filling out a form, it's really understanding the story of your finances
Mm-hmm.
and using that knowledge.
And our mission today really is to demystify these core concepts. We want to break down that jargon, make it less scary and give you the foundational understanding you need so you can navigate your own tax situation with hopefully some real confidence. We'll show you how each piece fits, why the rules are the way they are, and maybe trigger some of those aha moments you might have missed trying to figure it out alone.
Moving from just doing it to actually understanding it.
Exactly, from compliance to comprehension.
And we've got a fantastic set of sources today, really comprehensive stuff that lays out the nitty-gritty details in a way that brings clarity to, filing requirements, status, the whole structure of your tax obligation.
These materials are great guides for this complex area.
They really are. They'll help us uncover some surprising insights,
Yeah.
maybe even some strategic things to think about. So let's get started. Okay, let's unpack this thing.
Sure.
Before we dive into all the specific details, the numbers that make up your tax return, let's get a bird's eye view first.
Good idea.
We're going to look at the big picture. The individual income tax formula. Think of it like your financial GPS, a step-by-step roadmap showing how your taxable income gets calculated, which ultimately leads to whether you owe more money at the end of the year or hopefully you get a refund back. It's a very logical flow, actually.
That's a great way to put it, a financial GPS. The core flow, it really starts with your gross income.
Okay.
And this is, like you said, the widest net. It pulls in almost all the money, goods, property you receive from all sorts of sources during the year, unless there's a specific law that says, nope, this doesn't count.
Gotcha. So start broad.
Start very broad. From that gross income, you then subtract things called adjustments. People often call these above-the-line deductions.
Above the line.
Yeah, because they come off your income before you get to a really, really critical number. They reduce your income right at the start. So once you subtract those adjustments from your gross income, you land on your adjusted gross income. You'll almost always see this called AGI.
AGI. Hear that one a lot.
You do, and it's arguably one of the most important numbers on your entire tax return because it's like a benchmark. So many deductions, credits, even the phase-outs for certain benefits later on, they're all tied back to or limited by your AGI.
Wow. Okay. So it sets the stage for a lot.
It absolutely does. So
Yeah.
from your AGI, you then subtract either the standard deduction or itemized deductions.
Right. You choose one or the other.
Exactly. You pick whichever one gives you the bigger tax benefit for your situation. And that choice can really change the next step quite a bit. After taking either the standard or itemized deductions, you arrive at something called taxable income before the qualified business income QBI deduction.
QDI. That sounds specific.
It is. If you have income from a qualifying trade or business things, sole proprietorships, partnerships, S-Corp, you might get to subtract this QBI deduction. It's a special incentive for owners of these pass-through businesses.
Ah, okay. To lower their tax on that business income.
Precisely. And subtracting that QBI deduction finally brings you to your actual taxable income. This is the number, the exact dollar amount that the IRS applies the tax rates to. So once you have that taxable income figure, the federal income tax gets calculated. And it uses those progressive tax rates we have, meaning different chunks of your income get taxed at different percentages.
Right. The bracket system.
The bracket system, exactly. But you're not done yet. First, that calculated tax, you then subtract any tax credits you qualify for.
And credits are better than deductions, right?
Oh, much better, generally speaking. Credits reduce your tax liability dollar for dollar. Deductions just reduce the amount of income that's subject to tax. So credits give you a much more direct bang for your buck. Then finally, you might have some other taxes that get added on. This could be self-employment tax, for instance.
Right, if you work for yourself. Social Security and Medicare.
Exactly. You pay both the employee and employer parts. Or for some higher income folks, there's the alternative minimum tax, the AMT. It's like a parallel tax system to make sure everyone pays at least some minimum level of tax. Then, crucially, you subtract any payments you already made during the year, like taxes withheld from your paycheck or estimated tax payments if you made
Right,
those.
the money you already sent in.
Correct. And the result of all that math is either your tax due, meaning you still owe money, or the happier outcome, a refund, meaning the government owes you money back.
So what does this whole journey, this whole flow, really mean for you, the listener? Understanding this step-by-step roadmap is just crucial, isn't it? Because every single step impacts the next one.
Absolutely.
And that ultimately determines your final tax bill or your refund. It's not just, a random string of numbers on a form. It's really a story, a narrative of your finances for the year. It shows exactly how your earnings turn into your tax obligations.
Well said. Every piece has its place and purpose. Knowing that structure gives you a huge advantage.
Yeah.
And what's truly fascinating, going back to AGI, is how it acts like this crucial checkpoint, like a financial gatekeeper almost.
I take keeper like that.
Yeah. It's not just another number in the list. It's foundational. It dictates your eligibility for a surprising number of tax benefits down the line. Things like, can you contribute directly to a Roth IRA? Do you get the full child tax credit? Can you deduct certain education expenses?
Wow.
Often, the answer depends on your AGI falling within a specific range. Even the threshold for deducting medical expenses, which we'll get to, is based on a percentage of your AGI.
That pivotal. It influences everything downstream.
Exactly. Which means managing it strategically throughout the year can be really powerful.
That really highlights that cascading effect.
Yeah.
It feels like if you can strategically manage your AGI, maybe even before you file, that could be incredibly powerful. Okay, so let's zoom in now on that very first big step. Calculating your actual gross income.
Right.
This is the big pool, the base where everything starts, right? Before we start taking things away with adjustments and deductions.
Indeed. And gross income, it's intentionally a very broad category. The idea is to capture almost all forms of economic benefit you receive, unless the tax code specifically says this doesn't count.
Okay.
So let's dig into some common types and maybe some surprising ones, focusing on nuances a well-informed person would want to know. For most people, wages are number one.
Your paycheck.
Your paycheck, yes, but also bonuses, commissions, even the value of some fringe benefits from your employer. And if you're an independent contractor, it's the income on your 1099. No withholdings usually, which means different tax planning. Beyond wages, you've got interest income, savings accounts, bonds, loans you made, and dividends from stocks.
Right. Investment income.
Exactly. And a key thing here is knowing the difference between qualified dividends, which get taxed at lower capital gains rates, and ordinary dividends taxed at your regular rate.
That's important.
Very. Similarly, capital gain or loss. This comes from selling assets, stocks, bonds, maybe real estate. The holding period is critical.
Right.
Held it a year or less, that's short-term, taxed like regular income. Held it over a year, that's long-term, usually gets those better capital gains rates.
Okay, holding period matters.
Huge difference. Now, here's one that often catches people off guard. State tax refunds.
Wait, getting money back from the state can be taxable income.
It can. If you got a refund for state income taxes you paid in a prior year and you itemized deductions on your federal return that year, well, under the tax benefit rule, that refund becomes taxable income now.
Because you got a federal tax break for deducting it before.
Precisely. You benefited then, so the refund is income now. It makes logical sense, but it surprises people. Now, for anyone who's gone through divorce or separation, alimony received is something to consider, but there's a huge critical caveat here.
Okay.
It's only included in your gross income if the divorce or separation agreement was executed on or before December 31st, 2018.
Wow, that's specific.
Extremely specific. The Tax Cuts and Jobs Act of 2017 completely changed this. If your agreement was made after that date, alimony you receive is generally not taxable income for you.
That's a massive change.
It affects millions. The date of the agreement is everything. If you're self-employed, obviously business income is key. That's usually on your Schedule C.
Yeah.
It's your net profit after you deduct your business expenses. Good records are absolutely vital here.
I bet.
Then, as you move toward retirement, things like IRA income, pension, and annuity payments kick in as gross income. Whether IRA income is taxable depends if it's exec. Traditional, usually yes, because contributions were pre-tax, or Roth, usually no, because contributions were after tax.
Okay. Traditional versus Roth matters for withdrawals too.
Big time. For landlords, there's rental income or loss. Understanding depreciation and passive activity loss rules is key there. And if you're in a partnership or S-corp, you get K-1 flow-through income or loss.
Flow.
Yeah, the business itself doesn't pay income tax. The profits or losses just flow through directly onto the owner's individual returns via that K-1 form. Finishing up the common list. Unemployment compensation. Benefits you get when you're out of work. That's taxable income.
Okay.
A portion of your Social Security benefits can also be taxable. It depends on your provisional income, a special calculation involving your AGI, tax-exempt interest, and half your Social Security. If that number crosses certain thresholds, up to 85% of your benefits could become taxable.
85%. Wow.
It can be significant for some retirees. And finally, there's this catch-all category, other income. Basically, anything else that doesn't fit neatly elsewhere but is still taxable. Think gambling winnings, prizes, awards, maybe even certain lawsuit damages.
That is an incredibly wide net for gross income.
Wow.
What's like the most common thing people think isn't taxable but actually is? Or maybe the other way around.
That's a great question. The state tax refund one trips people up a lot. Also, the income levels where Social Security becomes taxable. Conversely, sometimes people mistakenly report non-taxable income, like qualified scholarships used for tuition.
Right. It shows how diverse your financial picture can be. But then, thankfully, we get to start reducing that big number, right? Before we even hit AGI, these are the adjustments.
Exactly. After you've added up all that gross income, the next step is subtracting these adjustments to income. We call them above-the-line deductions because they come off before you calculate AGI.
And that's good because AGI is that gatekeeper number.
Precisely. Reducing your AGI can unlock other benefits later on. So these adjustments are really valuable. Let's walk through some key ones, focusing on why they matter strategically. For teachers, there are educator expenses.
Right, for school supplies and things.
Exactly. They can deduct unreimbursed costs for books, supplies, classroom materials, up to a limit. It acknowledges those out-of-pocket costs teachers often have. Traditional IRA contributions are a really common and powerful adjustment for retirement savers.
Your contributions here can often reduce your current taxable income and the money grows tax-deferred. But there are AGI limits and rules about whether you have a retirement plan at work. That can affect if your contribution is actually deductible. So you need to check that.
Okay, it's not automatic for everyone.
Not always fully deductible, no. If you're paying off student loans, student loan interest can be an adjustment. You can deduct up to $2,500 a year in interest paid. Helps ease that debt burden a bit. Though this also phases out at higher incomes.
Another income limit.
Yes. And for folks with high deductible health plans, contributions to a health savings account, HSA, are fantastic. It's a triple tax advantage. Contributions are deductible, the money grows tax-free, and withdrawals for qualified medical expenses are tax-free.
HSAs are powerful.
They really are. Now, moving expenses. This used to be a common adjustment, but not anymore.
Oh.
Yeah, the 2017 tax law changed this dramatically. Now, this deduction is only for members of the armed forces moving because of a military order, a permanent change of station. So basically, nobody else gets it anymore.
For the most part, no. Very narrow applicability now. For the self-employed, there's several really important adjustments. You can deduct 1/2 of self-employment taxes.
Why half?
Because when you're employed, your employer pays half your Social Security and Medicare taxes, and you pay the other half. When you're self-employed, you pay both halves. This deduction basically makes up for the employer half you're paying. It levels the playing field.
Ah, okay. That makes sense.
Also, premiums paid for self-employed health insurance can be deductible, and contributions to self-employed retirement plans, like SEP IRAs or solo 401ks, these can allow for much larger contributions than traditional IRAs, offering huge tax savings.
Good options for freelancers or business owners.
Definitely. And one more small one. If you take money out of savings early and pay a penalty, that interest withdrawal penalty can be an adjustment. And just like alimony received, alimony paid has that same critical date rule. It's only deductible as an adjustment if the payments are under a divorce or separation agreement executed on or before December 31st, 2018.
Same date again.
Same exact date. If the agreement is after that, the payments generally are not deductible by the payer. It mirrors the change for the recipient. Those dates are absolutely crucial to track.
These adjustments seem incredibly powerful. Taking money off the top before you even hit that critical AGI number, it really does feel like it sets you up better for other calculations later. What's a common mistake people make here, or maybe an opportunity they miss?
Yeah, a common mistake with IRAs, like I mentioned, is not realizing the AGI phase-outs or how having a workplace plan affects deductibility. People might overdeduct, an often missed opportunity. For the self-employed, not maximizing those retirement contributions, SEP IRAs and solo 401ks can allow for really significant tax-deferred savings.
Good heads up.
So once you've taken all your adjustments and you've landed on your adjusted gross income, your AGI, you face that big choice: standard deduction or itemized deductions.
It's a fork in the road.
Exactly. The standard deduction is just a flat amount set by the IRS. It changes each year, depends on your filing status, and gets a bump if you're 65 or older or blind.
Simple and straightforward.
Very. And honestly, since the tax changes in 2017 roughly doubled the standard deduction amounts, a large majority of taxpayers now find it's better for them than itemizing. It's just simpler and often bigger. However, if your specific eligible expenses add up to more than your standard deduction amount, then itemizing is the way to go. It takes more work, more record keeping, but it can definitely lower your tax bill.
Okay, so what kind of things can you itemize?
Let's look at the common ones and their rules, which can be pretty strict. First, medical expenses. You can deduct unreimbursed costs for medical care, but, and this is a big but, only the amount that is more than 7.5% of your AGI.
7.5%. That sounds high.
It is a high threshold. If your AGI is, say, $80,000, you can only start deducting medical expenses once they exceed $6,000. So you really need significant costs, major surgery, chronic illness expenses for this to provide much benefit. Another big one is taxes, state and local taxes, often called SALT.
SALT deduction. Heard about that.
Right. This includes property taxes you paid on your home and either your state and local income taxes or your state and local sales taxes. You choose whichever is higher. But here's the really big limitation that came in with the 2017 law. You can only deduct a maximum of $10,000 total for all these state and local taxes combined.
Only $10,000. Even if you paid way more.
Even if you paid much more. That $10,000 cap applies whether you're single or married filing jointly. It's been a huge point of debate, especially for people in high-tax states like New York, California, New Jersey.
I can imagine that's a significant limit.
It is. You can also deduct certain interest expenses. The main one is home mortgage interest on your primary home and maybe a second home. But again, there are limits. For loans taken out after December 15, 2017, you can generally only deduct interest on up to $750,000 of mortgage debt used to buy, build, or improve your home.
Okay, $750K limit there.
Right. You can also deduct investment interest, but only up to the amount of your net investment income. You can't deduct personal interest, like on credit cards or car loans. Charitable contributions are another common itemized deduction. Donations made to qualified charities. For cash donations, you can generally deduct up to 60% of your AGI. For donations of appreciated property, like stocks, it's often limited to 30% of AGI.
And you can carry forward extra.
Yes. If your donations exceed those AGI limits in 1 year, you can usually carry the excess forward for up to 5 years. And finally, there's the casualty and theft loss deduction. This one is now extremely restricted.
Oh, so?
You can only deduct these personal losses if they happen in a federally declared disaster area. And even then, you have to subtract $100 per event, and the total loss must exceed 10% of your AGR.
Wow, another high AGI threshold plus a disaster requirement.
Exactly. So, like medical expenses, it only applies in very specific severe situations. Think hurricane damage, major wildfire loss in a declared disaster zone, and only for the amount above that significant hurdle.
This is really where your personal financial life, your spending habits, can directly hit your tax return. It's a strategic choice, isn't it? Does itemizing beat the standard deduction?
It is, and for many, the answer is no, especially with the higher standard deduction amounts now, the simplicity wins out. But for others, maybe homeowners in high-tax areas, even with the SALT cap, or those with large medical bills or charitable donations, itemizing is absolutely essential to minimize their tax. You really have to run the numbers.
Okay, so we've charted the course from gross income through adjustments down to that AGI gatekeeper and then the choice between standard or itemized deductions. But hang on, before we even start calculating any of this, there's a more fundamental question, isn't there?
Mm-hmm.
Do you even have to file a tax return at all? And if you do, when is the deadline? It seems basic, but I bet a lot of people aren't totally clear on this.
That's a critical starting point. Knowing if you need to file avoids stress and maybe missed refunds. Generally, you must file a return if your gross income, remember, that's income before deductions, is equal to or greater than the sum of your regular standard deduction amount for your filing status, plus any additional standard deduction if you're 65 or older or blind.
Okay, so it's tied to that standard deduction amount.
Exactly. For example, back in 2023, a single person under 65 had a standard deduction of $13,850. If their gross income hit that level or higher, they generally had to file. If they were 65 or older, the threshold was higher because they get an additional standard deduction amount.
Got it. But there's an exception.
Yes, a notable one for people using the married filing separately status. Their filing threshold is much, much lower. Often just $5 of gross income triggers a filing requirement for them. And beyond those income thresholds, there are other situations that force you to file no matter your income level. For instance, if you had net earnings from self-employment of $400 or more, you have to file.
$400, that's pretty low.
It is. Or if you received advance payments of the premium tax credit for health insurance bought through the marketplace, you have to file to reconcile that. So it's not just about hitting an income number. Specific financial events can trigger it too.
So basically, if your income or certain activities reach a specific level based on your age, status, and what you did financially, the IRS expects to hear from you.
That's the gist of it.
And it's not just about owing money, right? You might have to file, even if you're getting a refund, just to claim that refund.
Absolutely. You won't get your refund unless you file.
Okay, so when do you have to file? Is it always April 15th?
For most individuals, yes. The fixed deadline is April 15th. It's technically the 15th day of the fourth month after the close of your taxable year. Since most people use a calendar year that lands on April 15th, it's a date pretty much burned into our collective consciousness.
Definitely, tax day. But what if you can't make it? Extensions.
Yes, there's an automatic 6-month extension available, pushing the filing deadline to October 15th.
Automatic. So you don't need a good excuse.
Nope, no reason needed. But, and this is key, you must request it by filing Form 4868, the extension application, by the original April 15th deadline. Filing that form gets you the extra time automatically.
Okay, so you have to ask for it by April 15th.
You do. It's super useful if you need more time to get your documents together or things are complicated. However, and this is where people get really tripped up, leading to penalties, this automatic extension is an extension to file your return paperwork. It is not an extension of time to pay any taxes you owe.
Ah, that's the crucial distinction. Extension to file, not to pay.
Exactly. Your tax payment is still due on April 15th. If you estimate you'll owe money when you file the extension, you should send that payment in by April 15th. If you don't, you'll likely face penalties and interest charges on the unpaid amount, even though you have an extension to file the forms.
Okay, that is really important. An extension gives you more time to do the paperwork, get it right, but not more time to send the money. That April 15th payment deadline holds firm. What's the penalty like if you miss that payment deadline, even with an extension?
The failure to pay penalty isn't usually crippling initially, but it adds up. It's typically 0.5% of the unpaid taxes for each month or part of a month. The tax remains unpaid, and it's capped at 25% of your unpaid liability.
Plus interest, I assume.
Plus interest, which compounds daily. The biggest mistake is thinking the extension gives you a payment holiday. It absolutely doesn't. It's purely extra time for paperwork.
That's a vital clarification. Okay, let's shift gears now to a really critical piece of the puzzle.
Yeah.
Your filing status.
Mm-hmm.
This isn't just, checking a box on the form. It fundamentally impacts your standard deduction amount. It dictates which tax brackets apply to your income, and it even determines which credits you might be eligible for.
It's huge.
It really is. It's basically your tax identity for the year.
Mm-hmm.
Getting it right can make a big difference to your tax bill, maybe even your whole financial plan.
Absolutely. And what's fascinating is this common thread that runs through many of the statuses. The end-of-year test.
The end-of-year test.
Yeah. Generally speaking, your marital status on the very last day of the tax year, December 31st for most people, dictates your filing status for the entire year.
The whole year, even if you just got married.
Even if you tied the knot on December 31st. For tax purposes, you're treated as married for the full year. Same if you get divorced on December 31st, you're considered unmarried for the whole year. It simplifies things but can have big implications for newlyweds or late-year divorces. So let's break down each status, starting with the simplest. Single.
Okay.
This is pretty straightforward. You're considered unmarried for the whole tax year if, on that last day, you are either unmarried or you're legally separated from your spouse under a formal divorce or separate maintenance decree. It's the default for most independent individuals.
Simple, clear, but maybe not always the best option if you support others, right?
Exactly. As we'll see, other statuses can be more beneficial. Next up, Joint returns, or married filing jointly, MFJ,
The most common for married couples.
by far. To file jointly, you need to be married at the end of the tax year. This includes couples in legally recognized common law marriages, too. Interestingly, it also includes couples who are married but living apart as long as they aren't legally separated or divorced.
So even if they live separately.
Yes, if they're still legally married and not formally separated, they can choose to file jointly. And MFJ usually offers the most favorable tax rates and the highest standard deduction for married couples. It typically results in the lowest combined tax. A few specific scenarios here. Get married during the year. You can file jointly if you're still married on December 31st. Get divorced during the year. You cannot file jointly with your ex-spouse for that year.
Makes sense.
But, sadly, if one spouse passes away during the year, the surviving spouse can still choose to file a joint return for that year with the deceased spouse.
That's a compassionate rule.
It provides some continuity during a very difficult time.
So MFJ is clearly the go-to for most married couples,
Mhm.
often giving the best tax outcome. But what's the alternative for them?
The alternative is married filing separately, MFS. A married person can choose to file a separate return even if only one of them actually had income.
Why would someone do that if MFJ is usually better?
Good question. The impact of MFS really depends on where you live. In separate property states, that's most states, each spouse just reports their own income, their own credits, their own deductions on their separate returns. Pretty straightforward. But in community property states like California, Texas, Arizona, a few others, it's different. Most income earned and deductions related to that income acquired during the marriage are considered owned 50-50 by law. So even on separate returns, they generally have to split that community income and related deductions down the middle.
Wow, that complicates things.
It can. Now, MFS often results in a higher total tax for the couple compared to MFJ, but there are niche situations where it might be better. Like if one spouse has huge medical expenses, filing separately might lower their individual AGI enough to actually get over that 7.5% deduction threshold.
Strategic AGI management again.
Exactly. Or maybe one spouse wants to avoid being responsible for the other spouse's tax debts or issues. MFS separates that liability. Or sometimes it's beneficial for certain income-driven student loan repayment plans. But generally, couples should compare the tax results both ways before choosing MFS.
So it's an option, but usually less advantageous unless there are very specific reasons. Definitely not the default for saving taxes for most married folks.
Correct. The fourth status is qualifying widow with dependent child, QW. This one offers a significant benefit. It lets the surviving taxpayer use the joint tax return's standard deduction amount and the joint tax rates for up to 2 years following the year their spouse died.
So they get the MFJ benefits even though they're now single.
For a limited time, yes. It helps ease the financial transition. However, this benefit stops immediately if they remarry within that 2-year window. If they remarry, they'd file with their new spouse, either jointly or separately.
Okay, so it's temporary and conditional.
Very. And to qualify, the surviving spouse must pay over half the cost of keeping up a home that, for the entire taxable year, is the main home of their dependent child.
The whole year.
The whole year. And that dependent child must be their actual child or stepchild, including adopted but not a foster child. They have to meet the general dependent rules, too. It's specifically designed to help during that difficult period after losing a spouse.
A truly compassionate temporary status. Good to know about.
Absolutely. And finally, the fifth status, head of household, HOH.
This one seems important. After savings.
Yes, this status can provide significant tax savings. It allows certain unmarried taxpayers to pay lower taxes compared to filing single. They get a larger standard deduction than single filers, and the tax brackets are wider, meaning more of their income is taxed at lower rates.
So lower taxes. Who qualifies?
Okay, several specific conditions have to be met. It's quite detailed. First, you generally have to be unmarried or considered unmarried for tax purposes on the last day of the year. This includes being legally separated or being married but having lived apart from your spouse for the last 6 months of the year.
Last 6 months living apart. Okay.
Second, you can't be eligible to file as a qualifying widow that year. Third, you can't be a non-resident alien. And fourth, this is the big one, you must maintain a household that, for more than half the taxable year, is the principal residence of a qualifying person.
Maintain a household.
Mhm.
More than half the year.
Qualifying person, or you break down qualifying person. That sounds key.
It is absolutely key, and this is where the details really matter. A qualifying child can be a qualifying person for HOH. This means your child, stepchild, adopted child, foster child, brother, sister, or a descendant of one of them, who meets the general qualifying child rules, which we'll cover next. And they must have lived with you in that home for more than half the year.
Okay, child, grandchild, sibling, niece, nephew, living with you more than half the year. Correct. Now, interestingly, your father or mother can also be a qualifying person. And here's the unique part. Your parent is not required to live with you.
Oh, they can live elsewhere.
Yes, provided you maintain a home that was your parents' principal residence for the entire year. Maintaining a home means you paid more than half the cost of keeping it up. Rent, mortgage interest, property taxes, utilities, food eaten in the home, repairs, etc.
So if I pay for my elderly mom's apartment and groceries, even if she lives across town, she could make me eligible for head of household.
Potentially, yes, if you meet the other criteria. That's a common scenario where this rule applies. Now, for other dependent relatives besides your parent, like grandparents, brothers, sisters, aunts, uncles, nieces, nephews, step-relatives, in-laws, they must live with you for more than half the year to be a qualifying person for HOH.
So parents are the exception to the living with your rule.
Exactly. And it's important to note who isn't on this relative list for HOH purposes. Cousins, foster parents, and unrelated dependents, they don't count as relatives here. If they are to qualify you for HOH, they generally have to meet the qualifying child rules or live with you the entire year and meet all the qualifying relative dependency rules.
Wow, okay. The distinctions are subtle but critical.
They really are. And here's a helpful tip to distinguish between qualifying widow and head of household timing. QW requires the dependent child live with you the whole year. HOH requires the qualifying person live with you for more than half the year. That time difference is a key differentiator.
Whole year for QW, more than half for HOH. Got it. This HOH status really does seem to offer significant tax savings for single parents or people supporting specific relatives. Understanding who qualifies is absolutely crucial. Okay, speaking of qualifying people, let's talk about dependents. Understanding who counts as your dependent is incredibly important, right? It unlocks those filing statuses like head of household, but also tax credits like the child tax credit or the credit for other dependents.
Absolutely critical.
And it's not always as simple as they live with me or I pay their bills. The rules are quite specific, designed to make sure only one person claims the benefits for any given individual.
You're exactly right. And there are two main categories, two pathways to being a dependent. Being a qualifying child or being a qualifying relative. Some rules overlap, but they each have their own distinct set of tests.
Qualifying child, qualifying relative.
Okay, and to help people remember the tests, the IRS actually uses little acronyms. CARES for a qualifying child, and SUPPORT with one P for a qualifying relative.
CARES and support. Okay, let's break down CARES for a qualifying child first.
Sounds good. The C in CARES stands for close relative. The person must be your son, daughter, stepchild, foster child if placed by an agency court, brother, sister, step-sibling, or a descendant of any of these people, like a grandchild, niece, or nephew.
Yeah.
Legally adopted children count too.
So a fairly close family relationship.
Yes. The A is for age limit. Generally, the child must be younger than you and under age 19 at the end of the year. Or, if they're a full-time student, under age 24.
Full-time student means?
Attending school for at least part of each of 5 calendar months during the year. And crucially, there's no age limit if the individual is totally and permanently disabled at any time during the year.
Okay, under 19, under 24 if student, or any age if disabled.
Correct. The R is for residency and filing requirements. The child must have the same main home, the same principal place of abode as you for more than half of the tax year. Temporary absences like for school or vacation usually don't count against this.
Living with you more than half the year.
Yes, and the child must be a U.S. citizen or a resident of the U.S., Canada, or Mexico. Also, the child generally cannot file a joint tax return with someone else for that year unless they're only filing it to get a refund of taxes withheld and owe no tax.
Okay. Residency, citizenship, and not filing jointly.
Right. The E is really important. Eliminate gross income test.
Eliminate.
Yes. Unlike the qualifying relative rules we'll get to, there is no limit on how much gross income a qualifying child can earn.
Really? So my teenage kid could have a decent part-time job and still be my qualifying child?
Absolutely, as long as they meet the other CARES tests. That's a very common point of confusion. The income limit doesn't apply here. Finally, the S is for the support test. But it's phrased a bit differently for a qualifying child. The child must not have provided more than half of their own support for the year.
So they can't pay for more than half their own stuff. It's about who provided the support.
Exactly. You need to figure out the total cost of their support for the year. food, lodging, clothes, education, medical, recreation, and see if the child paid for more than half of it with their own funds.
What counts as support?
Actual expenses, things like food, housing, a fair rental value, clothing, education costs, medical care, transportation, even entertainment. And if the child receives Social Security or welfare benefits, those count towards their total support if they're actually spent on support items. But here's a really important exception for the support test. Scholarships received by your child who is a full-time student are generally not taken into account when figuring out if they provided more than half their own support.
So a big scholarship doesn't automatically disqualify them.
Correct. If the dependent is your son, daughter, or stepchild, or adopted foster, this scholarship exclusion does not apply if the student is, say, your sibling or niece and nephew. Very specific rule.
That scholarship exclusion is a huge deal for families with kids in college. So even if my kid earns some money, gets a scholarship, as long as they didn't personally pay for more than half their total living costs and meet the other CARES tests, they could still be my qualifying child. That clears up so much.
Absolutely. It makes claiming college students much more feasible for many families. Okay, now let's switch to the qualifying relative rules using the acronym SUPPORT.
Okay, support. Let's go.
The S here is also for the support test, but it's more direct. You, the taxpayer claiming the dependent, must have provided more than one-half, over 50% of the person's total support for the year.
So here it's about me providing over half, not about them not providing over half.
Exactly. It's a subtle but important difference. The definition of support what costs count is the same. You need to calculate their total support costs and see if you paid for more than 50% of it. The U in support is critical, under gross income limitation. This is the big difference from a qualifying child. A person cannot be your qualifying relative unless their gross income for the year is less than a specific amount. For 2023, that amount was $4,700.
Less than $4,700 in gross income. That's pretty low.
It is a strict limit. But remember, it's gross income. Only taxable income counts towards this limit.
So non-taxable income doesn't count.
Correct. Things like tax-exempt Social Security benefits, if their total income is low enough, tax-exempt interest from municipal bonds, or tax-exempt scholarships, those are not included in this $4,700 test.
So someone could receive, say, $15,000 in Social Security that isn't taxable and still be under the $4,700 gross income limit.
Precisely. If that was their only income, their gross income for this test would be zero. So they'd pass the U test, provided you meet the support test. The P stands for precludes dependent filing a joint return. Generally, you can't claim someone as a qualifying relative if they are married and file a joint return. The exception is the same as for a qualifying child, only if they filed jointly just to get a refund and had no tax liability otherwise.
Okay, same joint return rule.
Yes. The O is for only citizens of the United States or residents of the United States, Mexico, or Canada. Same geographic limitation as for a qualifying child.
Got it. U.S., Canada, Mexico.
And finally, the R and T combined for relative, or taxpayer, lives with individual. This test has two ways to pass. Either the person must be a relative, as defined by the IRS, or if they aren't a relative, they must live with the taxpayer for the entire year.
Okay, who counts as a relative here?
The list is specific. Children, grandchildren, parents, grandparents, brothers, sisters, aunts, uncles, nieces, nephews. It also includes step-relatives, stepchildren, step-parents, step-siblings, and in-laws, parent, sibling, son, daughter-in-law. Adopted and foster children count too.
Who's not a relative on that list?
Notably, foster parents and cousins are not considered relatives for this test.
Foster parents and cousins aren't relatives. Okay,
Yeah.
So what's the second part, the live with part?
If the person is not on that official relative list, maybe they're your friend, your foster parent, your cousin, then they must live in your home as their main home for the entire year to be your qualifying relative.
The whole year, not just more than half.
The entire year for this test if they aren't a qualifying relative, and the relationship can't violate local law. So to claim your cousin or your foster parent as a qualifying relative, they generally have to live with you all year long because they don't meet the relative definition.
That's incredibly detailed. Relative or R lives with you all year, if not a relative.
Support. Okay. But this raises a big question. What if, say, my siblings and I are all chipping in to support our elderly parent? None of us pays more than 50% alone, but together we cover everything. Does anyone get to claim mom?
Ah, yes. That's a very common scenario. And the tax code has a specific rule for it. Multiple support agreements.
Okay.
This rule applies when 2 or more people together contribute more than 50% of someone's support, but no single person contributes more than 50% on their own.
Exactly the situation I described.
Right. In this case, the group of contributors, who must all be qualifying relatives of the person being supported, or have lived with them all year if not related, can agree among themselves which one person will claim the dependent for the tax benefits.
So the benefit isn't just lost. Correct. But there are conditions. To be the one designated to claim the dependent under this agreement, a contributor must have paid more than 10% of the person's total support.
More than 10%.
And they also have to meet all the other dependency tests for a qualifying relative, like the gross income test, citizenship, etc., except for the 50% support test, obviously.
And how do you tell the IRS about this agreement?
The person who is designated to claim the dependent attaches Form 2120 Multiple Support Declaration to their tax return. The other contributors who provided more than 10% support but aren't claiming the dependent sign this form, essentially agreeing to let the designated person take the claim.
Okay, Form 2120. Let's use that example from the sources to make it really concrete. Peter is single, lives alone in Idaho, no income, supported by 3 people. Tim, unrelated friend, pays 48%. Angie, his sister, pays 43%. Mike, his son, pays 9%. Together, they cover 100%. Who can claim Peter under a multiple support agreement?
Fantastic example. It really tests the rules. Since Peter has no income, he passes the gross income test. He's a U.S. resident. He's single, so no joint return issue. The main hurdles are the support test, over 10% for MSA, and the relative lives with test. Let's check each person. First, Tim, the unrelated friend. Support. Yes, 48% is 10%. Gross income, joint return, citizenship, yes, Peter meets these. Relative or lives with, Tim is an unrelated friend. Peter lives alone. So Tim is not a relative, and Tim did not live with Peter all year. Tim fails this test. He cannot claim Peter.
Okay, Tim's out because he's not a relative and didn't live with Peter. What about Angie, the sister?
All right, Angie. Support. Yes, 43% is 10%. Gross income, joint return, citizenship. Yes, Peter meets these. Relative or lives with. Yes. Angie is Peter's sister. That makes her a qualifying relative. The lives with part doesn't matter since she's a relative. Conclusion. Angie meets all the tests. She can claim Peter under a multiple support agreement, assuming she gets Form 2120 signed by any other qualifying contributors, if Mike qualify, but he doesn't.
Okay, Angie looks good. Now Mike, the son.
Mike's issue is clear. Support. He only provided 9%. For a multiple support agreement, you must contribute more than 10%. Mike fails this test right away. Conclusion. Mike cannot claim Peter.
So even though Tim paid the most, only Angie can actually claim Peter because she's a relative and paid over 10%. Mike didn't pay enough.
Exactly. Peter only meets the full dependency definition for Angie in this multiple support scenario. It really shows how every single condition has to be satisfied. You can't just look at who paid the most money.
That example perfectly illustrates how you have to check every box. It's not just about the money. It's about the relationship, residency, income limits, and specific agreement rules.
One last really important area for dependents: the rules for children of divorced parents. This causes a lot of confusion and sometimes disputes.
I bet. How does the IRS handle that?
The general rule focuses on custody. The parent who has custody of the child for the greater part of the year is generally the one entitled to claim the child as a dependent for most tax benefits, like the child tax credit and head of household status.
Greater part of the year. So it's a time test.
Exactly. It's about where the child physically lived for more nights. And importantly, this time test usually overrides whatever the divorce decree might say about who gets to claim the child for tax purposes. The IRS generally looks at physical custody time first.
So reality over the paperwork, in a sense.
In a sense, yes. And it doesn't matter if that custodial parent actually provided more than half the support. The time test is primary for these benefits. Now, what if custody is split exactly 50-50? Say, 182 nights with one parent, 182 with the other, plus a leap day maybe.
Yeah, what then? Tiebreaker.
There is a tiebreaker rule. If the parents have equal custody time, the parent with the higher adjusted gross income, AGI, gets to claim the tax benefits related to the child.
Higher AGI wins the tie. Okay, that's clear.
It provides an objective way to resolve it. It's also worth mentioning that the custodial parent, the one with more time, can choose to release their right to claim the child to the non-custodial parent. They do this by signing Form 8332. The non-custodial parent then attaches that signed form to their tax return.
So they can agree to shift the benefit if they want.
They can. Form 8332 is the mechanism for that.
That makes sense. Prioritizing where the child actually lives most of the time seems practical, and having clear tiebreaker and release rules helps avoid conflicts. It seems designed to bring clarity to what could be a really tough situation for families.
Wow. We have really covered a massive amount of ground today. We went from that high-level tax formula, the whole GPS roadmap, all the way down into the nitty-gritty of who counts as a dependent under these very specific, sometimes really surprising conditions.
We certainly did.
I really hope this deep dive has given you, our listeners, a clearer, maybe more empowered picture of how individual income tax actually works. Moving beyond just, filling in the boxes on the forms to really understanding the structure underneath.
And this exploration really highlights how seemingly small details can have significant impacts, doesn't it?
It really does. Like whether a dependent lived with you for more than half the year versus the whole year, or the exact date an alimony agreement was signed, or those income thresholds where Social Security suddenly becomes taxable. Understanding these nuances is what empowers you to be truly informed.
Yeah, proactive instead of reactive.
Exactly. It lets you spot opportunities, maybe avoid pitfalls, because you understand the underlying rules. It's not just about compliance, it's about making informed decisions.
So, think about next steps.
Yeah.
What does this all mean for you, the listener? Armed with all this knowledge now, maybe take a fresh look at your own household, your income sources, your family relationships through this tax lens we've discussed. Are there opportunities, maybe, to optimize your filing status now that you understand the HOH or MFJ rules better? Or perhaps you can better understand your dependent situation, figure out who truly qualifies, and maybe unlock some valuable credits you didn't realize you were eligible for.
That's the key takeaway.
Remember, knowing the rules isn't just about following them. It's the first, most critical step to making those rules work for you. It could potentially save you money or just prevent headaches down the road.
Well put.
We really hope you enjoyed this journey into the, well, fascinating and often surprisingly strategic world of individual income tax. Until next time, keep digging deeper.